Good morning, everybody. Welcome to the Flow Show. We have 2 weeks left of trading, 2 weeks left of events and data and everything else, all getting squeezed into these last 2 weeks before we hit the holidays. It's going to be a busy one for central banks this week, on top of everything else coming as well. So get ready for a busy week. Morning, Kay. Are you ready for a busy week?
Morning, Ryan. Morning, everybody. We are ready for the busy week. Indeed, yeah, it's going to be packed with events. Not that we didn't have any events over the weekend already, but it looks like geopolitics can't sit still for the moment there.
No, absolutely. That's still going on, and lots of stuff coming out of China as well that has been influencing markets. So let's get stuck into talking about some of that stuff. Firstly, some data. Oh, look, I haven't even got my calendar set up yet. Look, see, Monday mornings. Hate Monday mornings. Never ready on a Monday morning. Right. Data. So we had some data out of China. CPI data coming in much worse than expected. CPI year on year coming in at 0.2%, was expected to rise to 0.5% from a prior 0.3% on the month, much worse. PPI coming in another negative, though not as much as expected, down 2.5%. That's seen Chinese. Well, we've had the headline this morning. Okay, now China, their Politburo, PBOC, various entities like to come out on a weekly basis, telling us the same old lines that they're going to remain prudent with monetary policy, except this time they changed it. After some 14 years, they've changed that line from prudent to now China monetary policy is to be moderately loose. Now, the market's taken a bit of a jump on this. You may have seen pairs like Aussie dollar ramping a bit higher on this hopium news once again that more easing is coming. It's a bit of a, yes, it is a change. It is a long-term change in their standing. But if you don't know their easing by now, given what they've done all this year with rate cuts, various programs, bond issuances, the whole shebang over the last, particularly the last 3 months, if you don't know their easing by now, then you don't really need a headline to tell you that at all. So that's what's happened this morning. They've changed this line. They are now going to be moderately loose after being moderately loose for the best part of this year. That's, as I say, we've seen a bit of a hopium move in pairs like Aussie dollar. We've also had news that they may have started buying gold again after pausing for a few months, according to reserve data, which has also been a bit of a tailwind for the Aussie, but it's done nothing for gold. So that's still languishing around this tight range that we've been sitting in. So the market hasn't really taken that as big news out of China. But long story short, we've got worse inflation data from China. That's going to keep them on the easing path anyway. They've changed some language, apparently started buying gold again, and that's where we are right now. They also say fiscal policy is to be more proactive next year. Kay, I want to ask you about this morning. Market making a mountain out of a molehill at the moment.
Oh, yeah, for the PB, the loose monetary policy. Yeah, I mean it's been going on since the start of the real estate prices, really. So yeah, that's not a big change. On the gold, though, if you look at the November move, that partially explains that move. Then, and you know what? I think it may also explain in parts. I'm not saying that they are actively buying, but I think Asians have been in as well. But that also may explain that we had gold holding certain levels post the Trump trade. We saw obviously a move back down in gold after the elections, but we are stalling, as I already mentioned, in a good number of times at relatively high levels overall. So I kind of thinking it helps gold to stabilize perhaps a bit higher than where it would have been otherwise. And that's how I look at it. So more like a bit the glass half full. Would it justify a move higher? It'll depend whether they buy in December or not. But I still think it's not only PBOC has been involved, but other parts of maybe those Chinese banks and things.
Spain politics.
Oh, hold on, my squawk. Yeah, so that's how I look at it, Ryan. Could have been lower otherwise, perhaps.
Yeah.
Yeah.
Yeah, absolutely. And we know that there's been other Asian central banks and other central banks buying gold as well. So we're not yet ready to take out this support. And, this support has been going on for a year now in gold. It's still not looking in any which way bearish at all, still maintaining the rally. So there's no real signs that that's yet to end, although, we've stopped going up for now. So that's always one signal why a trend may end. Anyway, right, moving on. Over in Japan, Mizuho Bank has announced it is hiking rates. They are raising their long-term prime lending rate by 0.05 percentage points to 1.9% effective early this week. That's putting it to the highest level in 15 years. Now, this rate is sort of a big benchmark rate for businesses. Do you think this is a bit of front running ahead of the Bank of Japan, Kay?
Sorry, mate. I was just looking at something else. What was the question?
The Mizuho Bank raising their long-term prime rate, which is I was just saying, it's a bit of a benchmark rate more than a actual rate.
Yeah.
It's only gone up the massive 0.05 basis points.
Yeah, it's 5 BP. It's 5 BPs. I'm not. It's just perhaps a year-end kind of thing. No, could be that for the last quarter of the fiscal year they put those rates a little bit higher. Is it front-running any moves by the Bank of Japan? I wouldn't say so. Just perhaps confirming a continuation of. Because as you highlighted also in our room, we've had this article, about the Bank of Japan.
Yeah, and that there's been a bit of an article out that they're having a meeting or the Bank of Japan are having meetings with firms ahead of their January rate decision, which Bloomberg has done a good job of spinning it into a rate hike scenario. Because they don't often have meetings or these sorts of meetings with businesses before their January BOJ meeting. It's a bit flaky, Kay, in terms of how Bloomberg have been spinning it. Doesn't really indicate anything, does it?
No, not for me. Again, we are in this continuation of. I mean, reporters are going to write about stuff and then trying to spin things as if to make it a big news somewhere. But no, I don't think a rare January speech. I mean, they're having speeches all the time. I mean, I don't know why they're putting such a dramatic in between brackets headlines on the article. The Bank of Japan members are talking all the time. It could also mean that. Okay, they may put some plans forward, but I'm not reading too much behind it. And you know what? If the market doesn't read too much behind it, we shouldn't either as retail traders.
Yeah, exactly that. Right, there's not been an awful else out. We did get a bit of GDP data at Japan final numbers, which showed a modest improvement over the prior. So GDP coming in at 0.3%. That was a little bit higher than 0.2 expected and prior numbers. Annualized quarter on quarter coming in better as well. CapEx wasn't down as much as expected. And as you can see, some GDP price indexes there as well, coming in a little bit softer than they were prior, but still sitting well above that 2% mark. Consumption quarter on quarter a little bit soft as well, but still a positive there. So nothing too much is old data now. We're just about to finish Q4, let alone what's been going on in Q3, but that will factor into the BOJ's thinking. Last week's data was all about the jobs and a bit of funky moves coming out. So we got the bounce back in non-farm payrolls, 227, so more than was expected, though it was round about the 200, 220 that a lot of people were looking for. So a decent bounce back there. The prior got revised up by 24,000 odd. However, what wasn't good news was the unemployment rate, which some had it coming in at 4.2 and some had it staying unchanged at 4.1. Either way, it rose a pip to 4.2%. That was even while the participation rate came down a pip to 62.5%. So that made it a double negative. You had unemployment going up even as people came out of the jobs market, i.e. actively looking for work. So a double negative there. Wages still there or thereabouts, probably coming 4%, was expected to drop to 3.9%, so stayed unchanged. That's really been sitting around that level for quite some time now. So overall, we got the bounce back, but the market took a little bit of a dour turn based on those unemployment figures there, which, yes, they do look worse, but we're not talking wholesale jobs losses. I personally think there's still a bit of washout from the weather stuff going on there, but I don't know. So overall, I didn't see it as a bad report, but the market saw it as a bit worse than I did. We've seen yields coming down, 10-year yields properly getting under that 4.20% level now, and the dollar getting a bit of a whack on the back of that number. Before I bring Kane to talk about that, we also had Canadian jobs, which pretty similar. We had a decent employment change number, more than double what was expected. Good on the revolving door, most of it going into full-time employment as well. But then we got another move down, unemployment rate jumping to 6.8%, jumping 3 pips. Different though was the participation rate rose in there, so you could add probably some of that rise in unemployment from the participation rising as well. So not quite potentially such a double negative as the US jobs report. But again, the market took that as we're looking at unemployment. That was much worse, and that's what it went with, at least as far as the loonie was concerned. So Kay, what did you make of that data? I mean, right for the market to maybe get a bit wobbly on the unemployment, but doesn't really change anything. We're still at decent levels. We're still not collapsing. It's soft landing stuff as usual.
Absolutely. And then taking it a bit backwards, I think the Canadian, yes, the unemployment rate who done it. Although the report itself was decent because it's full-time employment that had the bulk of the creations, well, all of them. So yeah, I think it's that unemployment rate. Bank of Canada this week. Market probably front-running the thing a little bit. I also would think, and it is not always obvious, and we've spoken about that. It jumps on and off the oil buzz, but oil has been weak, so perhaps that has contributed a bit as well to the Canadian woes. But I particularly think because we saw a bit of a dollar revival in the rest after the US numbers, that we're just hanging around there because the Bank of Canada is expected to move, and the potential for doing a 50 or the possibility for doing a 50 is still there. So yeah, I haven't traded the Canadian dollar. I couldn't really get myself over it to chase it when it broke above their 140.90 figure. And then on the US report is exactly as you say. This is not a bad report, but it is a good enough report, in my opinion, still to keep them just for doing this extra 25 BPs at the end of the year, and then we will see. Yeah, I mean, it is not a bad report, is it? I mean, the participation rate, okay. I mean, but you're talking about 0.1, 0.2%. We're talking about like really small things. If you look at where the market stabilizes today, obviously we had a bit of geopolitical event. We had a bit of those China data as well. and PBOC declarations or Ministry of Finance declarations over there. But basically, we are back to where we were before the give and take 5, 10, whatever pips. We are back to where we were before the report, and I think that more than that is not perhaps not justified at this time of the year ahead of those central bank meetings and stuff. So you look at the euro dollar, you look at a few of those dollars, right? You look at the euro dollar, you look at the cable, you look at Aussie Kiwi. They've all gone up and down, and now we're back in the middle. And that's perhaps now we start the central bank. The whole block of central banks, and also I'm keeping in the back of my mind year end perhaps.
Yeah, exactly. The good news on the central bank front is that the Fed and ECB are now in their blackout period, so we won't be hearing from those clowns for a while, even though they made sure the Fed anyway got their last views out before the weekend. But just before we move on to those, we did get the University of Michigan data coming out later on in the afternoon. These were flash numbers, so the first numbers for December. And altogether, we got an improvement on consumer sentiment, beating expectations, but it was a little bit wobbly in the other numbers. So current conditions have risen, but expectations have fallen. So things are looking good now, but expected to be a little less rosy in the future. On the
Trump
CPI
effect?
front, yeah, sorry, mate.
Trump effect, you think?
Yeah,
The
potentially.
immediate after.
Yeah, but I would have thought that expectations would have been up as well on the back of that. If you think it's, think Trump's going to be good now, he should be good for the future. So yeah, listen, it's a 500 person phone survey, so we should always bear that in mind. But
Yeah.
it is what it is. We saw 5-year inflation dropping a pip, but then we saw 1-year inflation going up 3 pips. So that again, it just gives the Fed a little bit of a pause. And this is going to be my question to you, mate. I'll go over the Fed heads first. So we had Fed's Bowman out saying she doesn't take dissenting to policy vote lightly. Inflation is the biggest priority when deciding policy. We're yet to achieve 2% inflation target, and economic conditions are very strong. Lowering the policy rate too fast could reignite inflation. And that progress on inflation seems to have stalled. She wants to proceed cautiously and gradually with rate cuts. Says labour market is near full employment and core inflation elevated. She's concerned if the Fed cuts rates too much, it could overheat the economy, and it's hard to think that interest rates are restrictive right now. So very hawkish comments from Bowman, who leans that way. Last comments were back latter part of November, also talking about cautious approaches. Fed's Goldbeast, he's a bit all over the shop as usual. Said 227 jobs is a big number, but we need to look at averages. Okay, go ahead. Fed is going to have a series of meetings that will be close calls between cutting rates and not. It's not seeing inflation and jobs conditions justifying a rate pause right now, though. Fed's Hammack says we may not be too far from neutral rate setting at or near the point where, or we are at or near the point where rate cuts should be slowed. Says current monetary policy is only somewhat restrictive. Currently sees 1 rate cut by the end of January. Fed's Daily says we are ready to raise rates if inflation breaks out again, and that December meeting is really important. I'm having another shift, Kay. I'm my percentage of whether they pause in December is rising. A lot of them all getting very pausey now, and while the focus has obviously been on employment, they made that shift early in the year between inflation and employment. They're shifting back to inflation, aren't they?
Yeah.
And with the inflation report this week, it could be the icing on the cake or the nail in the coffin, whichever way you want to call it.
Yeah. That brings it back right to the fore. Now we've had the employment numbers. Yeah, I understand how you feel, and we are probably close to a 50-50 whether they pause or continue to cut. I still lean towards the 25 BPs and then potentially a pause, and that could mean, that we are going to see, depending on the inflation, and I don't think we should expect. I'm just going to quickly look forward to what they expect on the inflation number. Where is it? It's Wednesday, right? Yeah, here we are. Oh, I've got only the PPI there. Where? Oh no, yeah,
Yeah, it's
no.
a tick up in headline and unchanged on core.
Okay.
They
Yeah,
can,
which is sort of what we may expect. Yeah, the surprise, of course, there would be that the headline inflation ticks back up to 3%, for instance. That would not be very good for the expectations of a Fed cut. Come out as expected. I think that would still tell us that they will lean because they're still well above 4%, right? So I mean, there's still a bit of room there, could be done before year end. I still lean that way unless we get an uptick in the CPI. Obviously, ahead of that, it's probably coin flipping right now.
yeah, yeah, I think exactly that. I think if we get either of these rising above expected, I think it really
Mm.
turns the screw on a pause for the December meeting.
The thing is as
You know,
well, the thing is
sorry.
as well, Ryan, is that independent of what the FOMC may do or not next week, I mean, if you get a bit of a sticky number there, the market will trade it. So, I mean, whether they
Yeah,
do or not, so that will be your market mover of the week for what the dollar is concerned, right?
yeah, exactly. And I just can't shake Powell's comments the other day,
Mm,
which I saw was really fairly bullish and
mm,
quite undovish. How the economy is doing much better than they thought
mm.
in September. Yeah, it's just I'm more 50-50 now, whether they go 25 or 50. I think if they go 25, there will be a strong signal that they're looking to pause.
Yeah,
And if they pause, well, that's probably going to catch the market on the hop a bit.
yeah,
So yeah, it's going to be as we said to start the show. It's going to be a busy week. Lots of jumping around with last minute data points and predicting what the Fed and others are going to do. So as you can see there, being Bank of Canada expected to go another 50. Do you think there's a risk that they might go a 25 this time,
Uh,
or is there
to
enough
me there is
justification for another 50?
no. To me there is a real risk that they disappoint the markets there. To me, there is. I mean, we know that McClem is a dove, but then you have his deputy governor. She's by no means one, and they've already done a few cuts. I think there is a distinct possibility that they only do 25 there, and maybe the market is getting a little bit ahead of itself. Trying to price aggressively and maybe needing to revise that once we get the Bank of Canada. I think there is a real risk that they do only 25 this time. I think that.
Yeah.
Mm.
So what happened to the old central bank mantra that they don't move policy too fast because there's a lag between when policy has an effect on the economy. Look at Canada; they've lopped off 125 basis points
Mm.
over the last 5 months.
Yeah.
You're not going to see
Um,
that coming through the economy just yet.
well, I th- uh, it's always tough to look at headline numbers and then the underlying trends and things like that. CPI has been coming off quite substantially in Canada. I think there also and there's a bit of this migration thing going on under the surface as well that's not always reflected in headline data, and I think that was in response to what things that are happening, and yeah, but the good thing somewhere about the Bank of Canada is that if you listen to McClem at least, he did give the market most, and he did give the market most of what he said on beforehand. So
Yeah.
Talking about this difference between the Fed and the Bank of Canada, he said that they could still be going, but there are limits to the differentials that they can have with the Fed as well. So there could be the difference between your 50 and your 25. Is it psychological barrier to go too wide versus the FOMC? And also, and I think that is why the ECB, for instance, may only do 25 instead of some people thinking that they may go 50 again, is the psychology of what is going to happen once Trump is in the seat. And it may have an effect on global monetary policies, by the way. And I'm in the camp of those who think they are going to keep some powder dry, and therefore in December we are not going to have like the big cuts. So that is where I stand right now, and yeah, we will see. We will see whether that is right or wrong. They can come out and go 50 BPs, but that's going to send the Canadian, maybe not against the dollar, but the Canadian, I think on the crosses, it's going to hurt.
Yeah, absolutely agree with that as well, mate. Agree with that as well. Right, Mr. Trump, he can't guarantee that tariffs won't raise US prices, and he won't rule out revenge prosecutions, as he says. So, giving everyone a heads up that if he does slap on tariffs, it could mean higher prices. Right, let's have a look at what's coming up this week. Sorry, Kane, this is any other headlines you've got?
No, Ryan, I think we're good for a Monday.
Yeah, cool beans. Right, not a lot coming out today. As ever, usually after NFP week, the data tends to die off a bit. As said, the highlight is going to be US CPI on Wednesday. So not a lot coming out today. Tomorrow morning, we get the RBA. That's going to be an interesting one, well, particularly for me because I'm still short Aussie dollar. And it's really going to be about whether they are going to move a bit further away from their more hawkish slant. They're sort of moved to a bit more neutral. Will they stay there, or will they move a bit more to the dovish side? I'm expecting them to stay where they are right now. So that stance won't help my Aussie short, but it's coming, and I think the market is expecting it to come as well now, given what we've seen happening in some Aussie pairs recently. But we'll find out what they're going to do and what they indicate more for 2025, more so than what they do at tomorrow's meeting. Some last minute inflation data. Yeah, sorry, mate.
I think the risk of staying too long hawkish. Well, we know that Bullock is a real hawk, but I think there's a risk that the RBA stays hawkish for too long. You know.
Yeah, no, I agree with that. And I actually, conversely, I would like them to stay where they are now in terms of rhetoric rather than indicate easing, because if they start indicating they're moving towards a more, setting up rate cuts next year, that'll probably destroy the expectation trade, and that's the one I'm hoping will make me money rather than when they do finally make the turn. So I want them to stay hawkish and the market to then start pushing their buttons.
Yeah, psychologically, it's you're right. If the longer they wait, the bigger the move once they start to turn, right?
Yeah, exactly. So yeah, unchanged for me, please, RBA, and stay on your path. Yeah. So Wednesday, CPI, Bank of Canada. Nothing else after that. On Thursday, it's SMB day and ECB day. So two more meetings from central banks there. Okay, SMB still going for a cut?
Yeah, they will. But again, their question, the market is pricing somewhere in between the 25 and the 50 BPs. I'm just seeing where they are versus inflation. The question is, do they want to take the monetary policy rate below inflation level? That is the question, because then you actually go back into real negative rates territory. If they do so, it's probably due to the fact they don't like their currency to be still on the stronger side of things. But do they use monetary policy, or will they use interventions or smoothing operations once if it's a big question, if we see a bit of a remake the last 2 weeks of the year for Swiss strength like we saw last year. I'm in between, but I'm also going to lean for the 25 there.
Yeah, I think you're probably about right for that, because they are fairly low already.
Mm.
We also get Aussie jobs data on Thursday. That will be particularly important, be straight after the RBA announcement, because that will just add or take away to whatever the market's doing following that announcement. So keep an eye on that one. The same thing with PPI, US PPI on Thursday as well. It will, potentially be icing on the cake, or just impact what we've seen from the CPI data. Then on Friday, a bit of a quiet one. Nothing out from the US of major note, or anywhere else for that matter. Some IP data from Europe, monthly GDP from the UK. So as far as the data front goes, we're going out with a bit of a whimper. Keep an eye on that Tankan number in Japan. So we're going back to Thursday, because I think one of the BOJ members has highlighted that as their watch point. Was it? Wasn't Nakamura? Can't remember who it was. Last week's, I think, one of the BOJ
Nakamura could be.
Yeah, mentioned it as his watch number in terms of what policy will do. So we'll just see what that one has done.
Yeah. What the Bank of Japan need is the Japanese companies to continue their capex, to continue to spend money, right? To invest. That's what they really need. And if they see that is a piece of the puzzle to add to potential Bank of Japan hiking rates. That's going to be an interesting discussion next week.
Yeah, we'll put that one off till next week.
Oh yeah.
Unless we get any sources out, because we're probably in the zone to maybe get the odd source drop. I think.
Yeah, we are. They could wait until post ECB or so, but we are in a bit of the time zone where they could do some or say something.
Yeah, exactly. So that's that from the data front anyway. So let's have a look at what's been going on, and let's start with euro dollar, because we did get the break of 106 on Friday, but as I mentioned, it's where it closed that was important. We've been pretty much saying this all Friday. It looking like it was building up for a bit of a blowout, and it did, but that didn't last very long, and here we are back below the number. So bit of a pressure steam release, but now we're back in the box.
Yeah, completely. I back in the box, or inside some kind of a wedge, like sterling, could be the case as well. 106 is again there. I figure 10, but I kind of agree with Mike, who says that the 25 BP cut is baked in for the euro. Is going to be data, and the way they bring it on later this week, we could be hanging around here for a while. We've seen the dollar giving back what it's taken on Friday, but not more. So we're kind of in the middle of the road now. For the short term, I would say we're kind of in the middle of the road. Look at the longer term, we're still hanging at around pretty decent levels for the dollar. That's about it. Now, I would say, what's next? That's the question. That's the question. What's next? Not what is happening now, but what's next?
Yeah, I mean, I think for euro dollar, if we see a secondary move up today through 106, that will be something that's more solid, perhaps, rather than this spike move that we got, because that will tell us that we've potentially finished going down, at least in the short term, and that the dollar is looking a bit weaker, potentially going into the Fed and the rest of the year. So a secondary move today, if we get a move up through 106 a day, that will be something that will probably be longer lasting, and then we might even be looking at running up to 107. But even after that move Friday, look where we held, right on the top of that zone. So we've definitely maybe we've definitely turned a bit of a corner in terms of what the price action has been doing. So we're probably in a bit of a dip buying mode for now. Yeah, ECB coming up. It's nailed on for 25 after the way they've been talking. So it's all going to be about the forecasts, because that's going to be about what they do next year. And if the forecasts show inflation coming down maybe further than they expect, then that's going to get the market getting all dovish about further cuts. Obviously, on the other side, if they're not as bearish on the forecasts, then that's another green light for euro to maybe claw back some of the losses we've seen from 112. So yeah, lots in the hat on that one. Euro sterling, while sticking on the euros, it's back above the line now. We're still spaffing around this line here. We can't hold below it, and that is really an important move, that we can't get below this 82.76 line. Though, as you can see, Friday last week we did hold under the 83 level, so a bit of a tight range for now. If we break above 83s, then we're probably going to see a bit more buying pushing us back up, probably towards that 83.40 area. But we keep coming under here more and more often, though we just can't hold underneath that.
What we need to see, Ryan, this week is how euro crosses are behaving, I reckon, as well in general. Because last week we had this, and we were talking about this very often in our room, the surprising weakness of antipodians versus the euro. That I'm not saying it's been reversed, but at least we had a peak of it overnight, early Asia, and then now we are coming down quite a bit. So that would be a bit of a change, and also I think well, indirectly, because all the crosses are not related, of course, but may also mean that we are going to continue. That's really slow. Yeah, EuroCAD is a bit of an exception because the Canadian dollar is weak, right? But it could also slowly weigh on euro sterling, for instance, into year end. Why not? If we see this demand in the euro crosses that we saw virtually every day in the European session last week, if we saw that wane a little bit, this demand, then I'm a bit short with you still on that euro sterling, and it's a very slow mover, but it could be just that grind into year end or so, that we are going to end up somewhere around 82, the figure. That's kind of my my expectation for that one.
Yeah, absolutely. Aussie dollar, that's tapping around this 64.40s, and you can probably take it up to maybe 55.60, up to that little area there as well. But we had this big move, looked like it was well on its way below, but now this, whatever news is driving it, gold, Aussie, China news, whatever's behind it, bit of a turnaround we've got here. Again, though, if it can't stay above this level, then it's going to keep the downside in play, and potentially another move down is going to head back towards these lows, which are going to be pretty important now around this 63.70.80, because we had that low and then it stepped up by 10 odd pips. So a bit of protective buying off that low, so that's given us a bit of an area on the downside ahead of this 63.50.60 area, which is a bit more of a longer term level down there. Quick look at my Aussie Kiwi, because that, again, I thought that was doing nicely, getting below this 109.50 area. I took a little bit off in that move into that area. I didn't take any off in that part, but we're back above, banging ahead on the 110 figure, which was previous resistance. We had a little bit of action around there, but when we got this first break below, it bounced to it and held it. We've had a little tap again. If it moves up, it needs to, for me, it needs to stay below this 110, 15, 20 area again, just to keep this downside move, this downtrend phase in play. So yeah, if it holds here, that'd be looking good, but I wouldn't be surprised if the RBA hold their rhetoric, that we see this maybe popping a little bit higher back over that level again tomorrow. So I'm not ruling out another upside move, but otherwise it's still looking constructive for further downside. Just last one, and then I'll punch it over to you, mate. While you're looking at all this China news, what's going on, keep an eye on the currency, because the currency is not doing anything. And that's your first indication that perhaps your currencies like Aussie dollar and everything else is moving on a bit of hopium, rather than China promising to flood more stimulus tomorrow or something like that. So dollar China still holding up at these elevated levels, but not moving an awful lot around on those headlines.
Yeah,
Gold. Yeah.
could be that PBOC's move is better for the trade partners than it is for China itself, right? If you keep your monetary policy loose, your currency should, in theory, not strengthen much. But if that helps trade and things like that, and or if that helps people coming back into the market or stuff, it may help those around. Yeah, so that may explain. I also think part of the Aussie move is due to tomorrow's RBA, because we saw the revival in the Aussie Kiwi, and I think that little part is probably RBA tomorrow already.
Yeah, a little bit of squaring up, perhaps.
Yeah.
Yeah, no,
All right.
I'm on board with that. Right, let me knock it over, mate.
So I'll do the Kiwi as well, Mike. Don't worry. So gold, constructive, I would say. Constructive. So yeah, I'm still long only as well on gold. I've been, as usual, I'm adding a little bit on dips, letting some go this morning around the level as well, but I remain long. This looks constructive, but it's also, we cannot forget that we are still in this box that we entered in end of November. It's going on 2 weeks now, is it? Yeah, absolutely. It's going on 2 weeks now that we are in this box. We need to get through those levels here. 60. 75 would be like a real strong signal if we get through there. But respect, first of all, what we are doing here. So this line may end up being a bit of a wishy-washy line as well, around 26.50. But if we hold today 26.5, that would be pretty constructive. In the meantime, as I already said, like more longer term, I think this to me still tells me we are stabilizing around pretty lofty levels, and it would not need too much of a lower dollar. Let's say, for instance, a surprising that week a CPI, we could be trading above 26.75. And also do not forget that we have year end coming, so there may be some stuff to do as well. So in any case, do not be surprised to see a bit of moves here and there that are perhaps unexplained versus fundamentals, or even technicals, for year end or so. But all in all, still a pretty decent, I would say, globally. On the Kiwi, where's my Kiwi? Here, Kiwi. We did have a look below here over on. Whoops. Yeah. Hang on a minute. Where am I? Oh, okay. Oh, I'm on the daily. Sorry about that, guys. I'm a little bit too long here. We did have a retest of those lows here that we saw on the 25th of November and bounced again pretty hard. We are, I did put a little bit support line here. We are back above, so that dragged me back into a small long derivation on the, sorry, Mike, on the Kiwi, but we are by no means out of the woods. We really, and we had like one move there and then came back down, but we really need to retake 59 figure 10 and hold it to continue higher. For as long as that does not happen, we may form a bit of a range here, around 58, 40, 50 as perhaps a hinge to lower or higher. I still think, and it remains unexplained to me why it was so weak last week, specifically last week. I don't think there was too much of fundamental justification, but we let the market. We have to let the market do its thing. And if we get back above 59 figure 10, I think constructive. Otherwise, we hang around and we are going to trade up and down here, Mike. That's what I think. Euro yen derivatives, yes. Interesting. I think especially what was interesting here is that we held this trend line roughly towards that we had last week. We held this trend line. Now we are starting to gradually or trying to crawl back above. First level of interest, we are turning around here, 159.35. We saw that little spike here on Friday up to 159.5. That's your little zone. If we get back above, I think it could push a little bit higher. Do I want to do anything? Not really, because I'm not a major yen bull, but I'm also not a euro bull, so I'm leaving euro yen alone. But what I see is that we big corrections, yes, but what I see is that we then equally start to rebound every time after those big corrections, and that we see pretty decent moves. A lot has to do with the volatility that we saw in yen. I mean, if you recall, end of last week or during last week in the yen, I'm gonna go. Yeah, well, the first thing which is interesting is that we are um, kind of holding the daily Ishimoku cloud, and we know that the Japanese are looking at that very closely. So watch this. On the other hand, we are also struggling to get over, um, and even we can't hold it over the 55 DMA, which is now at 153 quarters. So the range somewhere of support resistance is kind of tightening in my opinion, but what is still more important to me is that last week, for instance, we were again thinking that dollar yen was going to go much lower, especially when we went into the 148s, and yet look where we are. We are again above 150. The volatility is still there. Okay, I mean this looks like we are kind of trying to range inside 150 or so pips, but you look at an overnight move, it's already 100 points. So I mean, just bear that in mind with whatever you do in the yen. It's and it's probably going to continue to move into the Bank of Japan. After that, I don't know, but whatever you do in the yen or whatever you do in yen crosses, allow for moves that are still relatively sizable. Okay. Um, if I look at this globally, it doesn't really push me to do much. Yeah, we are bouncing, and we could go higher depending on what the ECB will do, and after that the Bank of Japan. But am I really pushed in doing much? Not really right now. What are you looking at, Deresh? Are you rally seller, or a lot of people I hear are planning to sell rallies, but I don't know. I still don't have like full confidence in the yen for more than a few sessions. That is, yes, we have like big moves, but then every time we do see rebound. So I'm not convinced that the yen is really the currency to own. But we will see. Year end can do a lot of damage to any pair. Um, Last one for the road here. Dollar makes. You have been short, okay, and you're looking to reload probably the range, like a lot of people are, but I don't know. I mean, you're looking to reload already here, or you're waiting for a move up to up in the 160s, for instance, closer to 161. That would be a better level, perhaps, looking at the activity that we had here before. That may be maybe a better level. Dollar mix. So we saw a bit of a grind lower. You know, last week, Scheinbaum and Trump they had a bit of a chit chat. We don't really know yet what Trump really wants to do, but in the meantime, we are slowly drifting lower. Okay. Any adverse news, this can get back into the 2030 straight away. I'm a little bit short, as the people know in our room. I am looking for a potential move somewhere into the 1990s. That's where I would be happy to already take some profit, because it is still, as I said, a very fragile recovery of the Mexican peso right now. But at least it has stopped doing those nasty spikes that we saw before. So I reckon there is a bit of a potential here to slip a little bit. Now we do have the Mexican CPI out in about 40 minutes, so that's going to be an interesting watch there as well. And with that, Ryan, back over to you, mate.
Thank you very much, mate. That's got us nice and set up for the week ahead. Going to be a busy one, so we'll look at the other central banks as we get closer to them as well. Have a wonderful week's trading, everybody. Stay safe. Remember, don't try and make your year in 1 month. If you've had a good year, take it easy. Put one eye on the holidays and having a nice long break and getting refreshed. Till then, trade well. Thanks, Kate. We'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.